For over 2 decades, there's been one number that's acted as a huge gatekeeper for retail traders: $25,000. If you've ever felt that frustration of being locked out of day trading just because your account was under that magic number, you know exactly what I'm talking about. Today, we're going to deconstruct the pattern day trader rule, a regulation that was born in a totally different era of trading, and well, it might finally be facing its own expiration date. Okay, let's dive in. So, here's the plan. We'll start by breaking down what this rule is and the impact it has. Then, we're going to rewind the clock to 2001 to see why it was even created. After that, we'll look at how traders have been getting around it, and finally, unpack the massive proposed overhaul that could literally change everything. We'll wrap it all up with one critical question you should be asking, and of course, the key takeaways. All right, let's get right to the heart of it, the core frustration that so many traders with smaller accounts have been dealing with for years and years. This quote from Humble Trader it absolutely nails the sentiment, doesn't it? It feels like such a basic question of control and freedom. It's your money, right? This is exactly why the rule has been so controversial for so long. Okay, so let's get into the official definition here. According to Finra, the regulator, you get slapped with the pattern day trader label if you make 4 or more day trades. That's just buying and then selling the same thing on the same day, all within a 5 business day window. There's also a little caveat that those trades have to make up more than 6% of your total trades. It sounds a bit technical, but really, it's a simple counting rule with some pretty major consequences. And this is the magic number. The whole thing revolves around this. If your account equity is below $25,000, that 4 trades in 5 days rule applies to you. But if you have more than $25,000, poof, you're free to day trade as much as you want without these specific limits. This one number has shaped trading strategies for countless people. So what happens if you break the rule? Well, the penalty is stiff. Your account can get frozen for 90 days. For any active trader, being on the sidelines for 3 months feels like an eternity. Your only escape hatch is to deposit more money to get that balance over the $25,000 line. It's a pretty serious penalty designed to be a hard stop. But why does this rule even exist in the first place? I mean, it wasn't just created in a vacuum. To really understand it, we've got to go back in time, all the way to the turn of the century. So, it's 2001, and the SEC and Finra, that's the Financial Industry Regulatory Authority, they put this rule on the books. But they weren't just making up rules for fun. They were actually trying to solve a very specific problem that had popped up in the markets. You have to picture the late 90s, the dot-com bubble. For the very first time, regular people were piling into day trading. But here's the kicker. Unlike today, every single trade came with a big commission fee. Regulators got really worried that new traders would get swept up in the hype, rack up a mountain of fees, and basically lose all their money, even if their trades were winners. The PDT rule was meant to be a kind of safety brake. And this simple timeline puts it all into perspective, doesn't it? You've got the 90s boom, which leads to the 2001 rule. And now, here we are, looking at a proposed overhaul for 2025. We are at a huge turning point for a rule that has been set in stone for nearly a quarter of a century. So, for more than 20 years, traders have had to live with this thing. And, as you'd probably guess, they've come up with some pretty clever and totally legal ways to work around it. Now, what's really fascinating here is the fundamental trade-off. The number one workaround is just to use a cash account, because it's completely exempt from the PDT rule. But there's a big catch. You can only trade with cash that has settled, and it takes 2 whole days for your cash to settle after you sell something. So you get freedom from the rule, but you lose what traders call capital velocity, the ability to use your money quickly. Another really popular strategy is just splitting up your capital. See, the rule applies on a per-account basis. So a trader with, say, $10,000 can open 2 different margin accounts at 2 different brokers with $5,000 in each. What's the result? You get 3 day trades in each account for a grand total of 6 in that 5-day period. It's a way to legally manufacture a bit more trading flexibility.
And that brings us to the biggest news on this topic in 2 decades, a proposed overhaul that could completely get rid of the pattern day trader rule as we know it today.
And this is the central question that's driving this whole change. I mean, the world is completely different now, right? We have 0 commissions, we have mobile trading apps in our pockets. The original reason for the rule, protecting people from high fees, has basically evaporated. So what's the new idea? This table just lays out the shift perfectly. The whole plan is to replace that rigid, one-size-fits-all $25,000 rule with a dynamic, real-time system. So instead of counting your trades, brokers would monitor something called an intraday margin level. And instead of getting a 90-day freeze after you break a rule, the system would just block a trade that would put you in the red before you can even make it. It's a move from a blunt instrument to a surgical tool. And frankly, it would force brokers to seriously upgrade their risk monitoring tech.
And look, this is not a small issue. According to Finra's own data, you've got about 54 million margin accounts out there. Now, while the number of accounts flagged for PDT is just a fraction of that, we're still talking about roughly 1.3 million traders. That is a lot of people who are directly affected by this rule. Now, this proposed change, it seems like a clear win for retail traders, right? More freedom, more flexibility, but it does lead us to one really crucial question. Just think about that for a second. We'd be trading a simple, maybe frustrating but understandable rule, the 25K limit, for a super complex, algorithm-driven system that could be different at every single broker. So is this new system really going to be more fair and transparent? Or are we just creating a new kind of black box that traders have to figure out all over again? Okay, let's wrap this all up and boil it down to the most important points to remember from this whole explainer. So here's the bottom line. The PDT rule is a 20-year-old regulation that targets traders with less than 25 grand, and it was created because of concerns about high commissions. For years, traders have used workarounds like cash accounts or multiple margin accounts. But now, Finra is proposing to scrap that entire system for a modern, real-time risk monitoring approach. And this could fundamentally reshape the entire landscape for retail traders. This is not financial advice.